Enron was created in 1985 when Houston Natural Gas merged with InterNorth. At the start, it was a conventional pipeline business. Its main activity was transporting natural gas and charging fees for the use of its pipelines. This was a reliable, low-risk model that produced steady income but limited growth. The late 1980s and early 1990s brought deregulation to the U.S. energy industry. Deregulation meant that energy companies no longer had to operate under fixed government-set prices. Instead, prices were left to be determined by supply and demand in competitive markets. For most utilities, this created uncertainty and risk. For Kenneth Lay, Enron's founder, deregulation was an opportunity to build something bigger. Lay envisioned Enron as more than a pipeline company. He hired Jeffrey Skilling, a consultant from McKinsey & Company, who argued that Enron could transform itself into an energy trading firm. Instead of simply delivering natural gas, Enron could buy and sell long-term contracts, speculate on future prices, and effectively become a marketplace for energy. This was a radical shift at the time. Competitors were cautious, but Enron pursued the idea aggressively. In 1999, Enron launched Enron Online, the first web-based platform for energy trading. For the first time, natural gas and electricity contracts worth millions could be traded instantly with a few clicks. This made Enron look less like a utility and more like a Silicon Valley tech company. Investors, analysts, and journalists praised Enron's innovation. Fortune magazine named it the most innovative company in America for 6 years straight. Inside Enron, the culture was shaped by Skilling's philosophy. He declared that employees were the smartest guys in the room. In reality, this created an intense and competitive environment. Employees were ranked each year, and the lowest ranked were fired. Bonuses were tied to short-term performance, particularly to the appearance of revenue growth. The system rewarded risk-taking and aggressive accounting, while punishing caution and long-term thinking. This culture set the stage for the practices that followed. The illusion of profits. By the late 1990s, Enron's stock price soared. From just $7 a share in 1997, it climbed to over $90 by 2000. Investors believed Enron had discovered a formula for unlimited growth. The truth was more complicated. Energy markets are volatile. Prices swing with changes in weather, demand, and supply. No company can deliver smooth, predictable earnings every quarter. To maintain the illusion of steady growth, Enron turned to aggressive accounting. The key method was mark-to-market accounting. Under traditional accounting, profits are recorded when they are actually earned. Under mark-to-market, Enron recorded the present value of all expected future profits the moment a contract was signed. For example, if Enron signed a 10-year deal that it predicted would generate $500 million in profit, it could immediately report all $500 million as current income, even though no cash had yet been received. In practice, this gave Enron enormous flexibility. If executives projected higher profits, they could immediately boost reported earnings. If market conditions changed later, the shortfall was hidden in future periods. A small change in assumptions about prices or demand could add or subtract millions from reported income. This meant earnings reflected management's optimism, not actual performance. To illustrate the distortion, consider a real-world case. Enron signed a 20-year contract to supply electricity to a local utility. On day one, Enron booked hundreds of millions of dollars in profits, but the actual project was delayed, costs escalated, and demand never materialized as expected. The income had already been reported, but the real cash never arrived. Investors saw profits that only existed on spreadsheets. This method created a growing gap between reported profits and real cash flow. While Enron told investors it was generating billions, its cash reserves were thin. Executives, however, were rewarded immediately with bonuses and stock options tied to reported earnings. This encouraged more aggressive assumptions each quarter, driving the company deeper into illusion. Hiding debt with special purpose entities. By the late 1990s, even inflated accounting numbers were not enough. Enron faced mounting debt and underperforming projects. To conceal the problems, CFO Andrew Fastow created a network of special purpose entities, or SPEs. SPEs are legally separate companies. In legitimate use, they isolate risk and keep specific liabilities off a parent company's balance sheet. Enron used them to disguise losses and hide debt. The process was simple. Enron would move a troubled asset, such as a failing power plant, into an SPE. On Enron's books, this looked like a sale that generated cash. In reality, the SPE was funded with Enron's own stock or with loans guaranteed by Enron. The risk never left Enron, but investors saw cleaner financial statements. Fasto created dozens of these partnerships, including LJM1, LJM2, and the Raptors. They were presented as independent, but in reality, Fasto controlled them. This allowed Enron to record gains and conceal losses while shifting billions in debt off its balance sheet. Investors were misled into thinking Enron was less leveraged than it truly was. Fasto personally profited from these arrangements, taking home tens of millions in fees. Other executives also benefited as the inflated financial statements supported higher stock prices. Meanwhile, employees were told to keep investing their retirement savings in Enron stock, while top executives sold their shares quietly. Wall Street banks such as JP Morgan, Citigroup, and Merrill Lynch helped finance these SPEs. They earned large fees while enabling Enron to maintain the illusion of profitability. Analysts, many of whose firms did business with Enron, continued to issue glowing recommendations. The financial community as a whole failed to challenge Enron's opaque structures. Red flags in 2001. By 2001, the pressure was becoming impossible to ignore. In August, Jeffrey Skilling abruptly resigned as CEO, citing personal reasons. Investors were alarmed, for the architect of Enron's strategy to walk away so suddenly suggested serious problems. That same month, the Securities and Exchange Commission launched an investigation into Enron's off-balance sheet partnerships. Regulators suspected that the company was hiding debt through its SPEs. Inside Enron, employees were also raising alarms. Sharon Watkins, a vice president, wrote a memo to Kenneth Lay, warning that Enron could implode in a wave of accounting scandals. Watkins had reviewed the company's structures and recognized that they were unsustainable. Her warning was one of the first major whistleblower moments inside Enron. Lay downplayed the issue, treating it as a communications challenge rather than a financial crisis. The company issued vague statements to reassure investors. Executives relied on complex, jargon-filled presentations to obscure reality. Analysts and journalists who pressed for clarity were met with evasive answers that explained little. In October 2001, Enron admitted it had overstated profits by $586 million. Investor confidence collapsed. The stock, once near $90, fell to below $1 by the end of November. The unraveling was underway, and it was irreversible. Collapse and bankruptcy. The collapse was swift and devastating. Employees saw their savings vanish. Many had invested heavily in Enron stock through their 401k plans, encouraged by management to trust in the company's future. At the same time, top executives had already cashed out, selling shares for millions before the decline. On December 2, 2001, Enron filed for bankruptcy. At $63 billion in assets, it was the largest corporate bankruptcy in U.S. history at that time. The once celebrated company became a symbol of deception and failure. The fallout extended beyond Enron. Arthur Andersen, one of the world's 5 largest accounting firms, was deeply implicated. Andersen had earned millions in consulting fees from Enron while also auditing its financial statements. When investigations began, Andersen employees destroyed thousands of documents. The firm was convicted of obstruction of justice. Although the conviction was later overturned, Andersen's reputation was ruined. It surrendered its license to audit public companies and collapsed. Major banks that had supported Enron structures were also penalized. JP Morgan, Citigroup, and Merrill Lynch paid hundreds of millions in fines. Shareholders filed lawsuits that dragged on for years, seeking compensation for the billions lost in Enron's collapse, legal consequences, and reform. The legal consequences for Enron's leaders were severe. In 2004, Jeffrey Skilling was convicted of fraud, conspiracy, and insider trading. He was sentenced to more than 20 years in prison, though his sentence was later reduced after appeals. Kenneth Lay was also found guilty, but died of a heart attack before sentencing. Andrew Fastow, who had built the SPE network, pleaded guilty and cooperated with prosecutors. He served 6 years in prison. The scandal destroyed Arthur Andersen. Once a respected global accounting firm with nearly 90 years of history, Andersen collapsed, and 85,000 employees lost their jobs worldwide. The case highlighted how conflicts of interest between auditing and consulting work could undermine independence. The wider financial industry also faced consequences. Banks that enabled Enron's transactions avoided criminal convictions but paid large fines. The episode revealed how deeply intertwined Wall Street had been in facilitating the fraud. The scandal prompted sweeping reform. In 2002, Congress passed the Sarbanes-Oxley Act. The law required CEOs and CFOs to personally certify the accuracy of financial statements. It created the Public Company Accounting Oversight Board to regulate auditors, tightened rules for auditor independence, and imposed harsher penalties for fraud. Sarbanes-Oxley transformed corporate governance in the U.S. and remains one of the most significant reforms in modern history. Lessons from Enron. The Enron scandal revealed how legitimate financial practices can be twisted into tools for deception. Mark-to-market accounting and special purpose entities are not inherently illegal, but Enron exploited them to inflate profits and bury debt, misleading investors and regulators. It showed the dangers of short-term incentives. Executives earned bonuses and cashed out stock options based on reported profits, regardless of whether the business was generating real cash. Employees, in contrast, tied their futures to Enron stock and lost everything. It also exposed failures of oversight. Analysts ignored warning signs because their firms earned fees from Enron. Auditors signed off on questionable practices because they profited from consulting contracts. Regulators reacted too late. The system designed to protect investors failed at every level. Perhaps the most important lesson is about perception. For years, Enron was hailed as the most innovative company in America. Its complexity and jargon discouraged even experts from asking basic questions. Where is the cash? How does the company make money? The willingness to believe the hype allowed the fraud to continue until it collapsed. Enron's legacy extends beyond its own downfall. It is studied in business schools and law schools as a case study in corporate governance failure. Comparisons have been made to later crises, such as WorldCom and Lehman Brothers. In each case, the same themes appear: aggressive financial engineering, conflicts of interest, and a culture that prioritized growth and perception over transparency and sustainability. Enron remains a warning of how far corporate leaders will go when incentives are misaligned, oversight is weak, and the story is too good to question. If you enjoyed this video and deep dive into the history of one of the most famous economic downfalls, click on the like button and don't forget to subscribe.